Lesson 1.6, Crypto versus Stocks. So, a concept that's confusing to beginners is the difference between stocks and crypto. Simply put, stocks measure the value of equity or ownership in a particular public company, primarily due to past, current, and prospective business performance, but it could be other reasons too, such as the overall economic environments, etc. Cryptocurrencies, on the other hand, measure the value of a currency within a particular economy. So these are two slightly different nuances here. So somewhat similar, but they are definitely apples and oranges. While stock structurally must be associated with a product or service that derives from the company and gets sold to customers, a cryptocurrency is solely associated with token usage in terms of how it derives value, essentially. So because cryptos only require token usage to gain monetary value, this is partially why crypto is more volatile than stocks, because token usage can vary by 1,000% overnight, and then minus 99% the following day, technically. And it just depends, what the cryptocurrency is used for, what marketing it has, etc. A few different reasons, but realistically, it can do those type of ranges. Whereas with a stock, sales, profits, revenues, etc., can't increase or decrease in the same fashion. It's going to be a far more gradual progression, and hence why the returns reflect that in the respective asset classes. So another reason why cryptocurrencies are more volatile than stocks is because stocks debut on the markets at a later stage in their life cycle than cryptocurrencies. So in my model, which I call the price cycle or the price life cycle, all assets have a birth price, apex price, and a death price. These represent the theoretical price points of assets, in this case, obviously crypto and stocks. When companies go public, they are typically years away from the initial conception of the organization, meaning that the asset growth potential was typically only available to founders and early investors. Hence, after they IPO, which requires typically meeting extremely stringent criteria from the top exchanges, typically the New York Stock Exchange, the NASDAQ, or it could be the London Stock Exchange, it could be in Tokyo, whatever. But wherever they are, they typically have to have a whole bunch of stringent criteria, such as minimum revenue, minimum amount of customers, or something along those lines. So basically this means that a lot of the initial growth that you see on the little image before has already occurred and is not possible for the public to experience in either the bullish or positive or bearish negative direction. So on the other hand, because cryptocurrencies can be placed on DEXs immediately after being minted, or decentralized exchanges, then they're also able to be traded immediately after that to establish asset price and value. They naturally have greater appreciation potential. I have to edit that after that, but yeah, they naturally have greater appreciation potential. So if you just look at this image, you can naturally tell that the greatest potential for growth is obviously going to be on the bottom. And so because cryptocurrency is just code and it's not a particular stock that has to be issued by the New York Stock Exchange or any of these bigwig places that require a whole bunch of fees, lawyers, paperwork, all that type of stuff, because of that, cryptocurrencies structurally, naturally have a higher likelihood of bringing those wild returns that you see on the news in cryptocurrency, where one person has like $1,000 of Shiba Inu and all of a sudden it's worth $10 million or something like that. That's only possible within crypto due to this model, in my opinion, not because cryptos are somehow well, in my opinion, they are superior assets, but it's not due to magic. It's just due to how they're set up as particular assets. So Bitcoin debuted at 0.008 and has a current all-time high of $69,045 according to CoinGecko. When you do the math, that's an 86.3 million fold multiple only done within its 13 or 14 year history. Because cryptos start earlier on their price cycles, these assets are much more egalitarian, in my opinion, than stocks, because only retail investors typically go after smaller assets. So if the assets turn out to be majorly successful, a small 3-digit bankroll could realistically turn into 7 to 10 digits worth of wealth, or you really see 10 digits is really the highest, but realistically, for 3 digits can turn into 5 to 10, and literally tomorrow or next month, next year, in the next 2 years. Whereas with stocks, that's not really going to happen unless you just hit it big. And you definitely, if it hit it big, it's only going to happen, one, two, 3 times compared to cryptocurrency, where that could happen with pretty much any token, if the project is sound enough. So even though that's the case, on the flip side, people ought to be greatly concerned with how price develops per cryptocurrency, why the general public is interested in said token. So, for example, the reason why I'm not a fan of Bitcoin is because future growth relies on crypto OGs, and call them crypto OGs, that's the industry, that's a colloquial term, but crypto OGs are just people who are early into cryptocurrency, which are typically just early Bitcoin miners or very early cryptocurrency enthusiasts from 2010, 11, 12, those type of years. So it relies on these people to not sell their Bitcoin, which is potentially literally at millions of % discount. Some of these people got Bitcoin at $50, $100 worth of, or per Bitcoin, when people come into the token and further push up price and gains. So that just basically means that as people are shooting for Bitcoin to all-time highs, or to 100,000, 250,000, you have to understand that the only reason why it's able to go up there is because people who got it at $1, $5, $10, who are still holding it today, or $100, $1,000, $5,000, whatever you want to do it, or whatever price you want to have it at, is because they're not selling. But the whole point is that if the appreciation is literally, tens of millions of fold, at what point in time do you think these people are going to sell, or think that there's not going to be as much gains, or might want to cash out of their position and enter in more attractive or more higher returning assets, such as, in my opinion, BNB, Ethereum, Matic, etc. So that's kind of my point. So I think that because of that, how you say, because of that mechanism within Bitcoin, that the use case, or the primary motivation for price appreciation is really the speculation. There will be an apex point in which the general Bitcoin community won't see that there's going to be any more reasonable appreciation within the coin. So, according to the price cycle and basic physics, you know that the growth rate of an asset will be the slowest higher up to the asset apex price than when it's closer to the birth price. If the saying is buy low, sell high, and Bitcoin is currently at $23,281 at the time of writing, which is currently a 29.1 million fold premium from birth price, you'd have to ask how many more millions, in terms of percent, can Bitcoin go before retracing back. And just as an example, an $800 Bitcoin, which right now seems impossible to ever happen, is still a 1 million fold premium from birth price. So, in the case of an extreme Bitcoin bear market for, extended 3 years, 5 years, 7 years, whatever, if it ever were to go down to $800 per Bitcoin, it's still 1 million fold premium from 0.008 originally. Knowing this now, you understand why new crypto projects tend to always get funding, because there's not much room to fall if you're starting from the ground floor, and the potential upside is potentially millions of percent. And yeah, so that's why you get a whole bunch of, they're called quote unquote shit coins, but shit coins are just early startup coins, such as Watch to Earn. The reason why these are better investments than, let's say, penny stocks, which are considered the equivalent in the stock world, is because cryptocurrency is based on its usage. So right now, Watch to Earn only has 20-ish holders within its economy, but when it has 200, 1,000, 200 or 1,000 token holders, eventually, the price of it will increase, especially how it's set up with the corporate token. Whereas with a penny stock is typically with stocks that have useless inventory, useless products, or they're just not good at management, or they don't have good sales, something like that. So the likelihood of investing into a penny stock and that going up, to make you millions of dollars, is going to be far less in your favor than investing into a lower cap or indie cryptocurrency project. Novice investors look at the most established cryptocurrencies for safeties with the same mindset that they do with stocks. They don't realize that if an asset can do tens of millions of percents upwards, 85% to 98%, realistically, sometimes with cryptocurrencies, like 99.9 or 99.5% drop is more than possible. And just because you just have to do the math on that. Hence, cryptocurrency structurally favors new projects and retail investors. And in my opinion, this is absolutely great and one of the main reasons why I'm pursuing crypto related ventures for my professional career. So I'm really dedicating my entire professional career to cryptocurrency related stuff. So I believe truly, I need to fix that too. I truly believe that cryptocurrency is the way how global poverty gets eradicated and how unprecedented levels of wealth can be grown, equitably be shared globally for all working class and impoverished people as long as they have access to the internet, without taking anything away from the already affluent and wealthy, which tends to be the caveat with, socialist policies or ideologies, or also with, policies or ideas such as universal basic income. The question is, where does this money come from? And it's always from corporations. It was always from businesses, or corporations, or from rich folk. But with cryptocurrency, because of the manner and how it feeds the developers, it feeds the early community members, and then eventually, as the token develops, then it's the general public, then it's the big institutions, then it's the governments, such as El Salvador with Bitcoin currently, for example. So because it happens in that order instead of with stocks, which kind of happens in the opposite order, where when Facebook is pre-IPO, is just between Mark Zuckerberg and whoever invested into Facebook early, which is typically big wigs, big angel investors with big bankrolls, not the everyday person like me or you. So that's the reason why I like crypto a lot, is because it's super egalitarian. And on the right, before we move on, you guys can see on the price cycle kind of what I mean by in terms of apex price, birth price, death price. You'll see watch to earn is pretty much at our birth price here. We're at sub dollar, where we used to be sub penny. We used to be sub penny and sub 10 cents. Right now we're a little under 10 cents, I think like, like 8.3 cents, give or take. But yeah, we're at our very beginning, where BNB, in my opinion, is the strongest candidate for the MVP of next crypto bull run, which I've been saying. So you put BNB here, you put Matic there. Then in between BNB and Bitcoin, you probably put Ethereum, and then you have Bitcoin here, where, in my opinion, at least for the medium term, so which is probably the next 5 years, I truly do think this is kind of like the end for Bitcoin's dominance. I think that Bitcoin is going to fall in terms of market dominance, while other cryptocurrencies, other altcoins, kind of take their place. And that's why I think Bitcoin is there at the apex. And then FTT, if you're not aware, FTT is a token for the FTX crypto exchange that just blew up a few months ago. I think it was in November of 2022. And so that's where death price is. And the reason why death price on the model is a little higher than birth price is because with cryptocurrencies, or with most assets, they're never going to go to exactly $0.00. But the reality is that there's essentially, when they're dead, or when there's a huge conspiracy or controversy or something along those lines, and it's pretty much a non-recoverable drop in price and drop in enthusiasm regarding the assets. So once you have this in mind, and you're going to see this with the other lessons, when you have this model in mind, it's going to be very great for you guys to understand the potential and the risk profiles for associated cryptocurrencies, where the average person, like I said, they jump into Bitcoin swearing up and down that, oh yeah, it's the best, it's the number one, it's lasted for the longest. But it's like, if you're buying at $69,000 expecting it to go to 100,000, 250,000, it's like, well, it just went from 1,000 to 69,000. So it's like, don't you think it should go down? So that's kind of my logic. You would think that's straightforward, but hey, I've had many a debates. Anyway, final